Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome Andy Schectman to the program, an expert in the gold and silver space and the CEO of Miles Franklin Precious Metals. We're going to discuss the ever-shifting post-Liberation Day landscape and try to figure out how Trump's tariff tactics will affect precious metals markets. We're going to talk about why we could be on the verge of a monetary system reset and a new gold standard. We're going to discuss the ever-increasing silver deficits running alongside robust demand and what that could mean for the silver price in 2025, and so much more. I hope you'll enjoy my conversation today with Andy Schectman. Andy Schectman, great to have you back on the program. We have to kick things off with the aftermath of Liberation Day, the Trump tariff fiasco. First putting different tariff rates on different countries, then pulling a U-turn, putting a 90-day pause, reducing the tariff rates on the vast majority of countries. And China, however, has retaliated. Retaliatory tariffs, they're starting to export even more minerals than they were before, particularly in the rare earths category, looking like it could be the start of a trade war between the U.S. and China. I wonder what your thoughts are on the overall fallout from Liberation Day and how you felt about the whole thing. Was this the art of the deal? Was this a 4D chess? Was this an economic blunder? Was it somewhere in between? And how do you think this is all going to play out?
Yeah, I appreciate that, Jesse. It's good to be back. Yeah, look, it started out certainly as a negotiating ploy, but I think the fallout to the stock and the bond market, both falling at the same time, which was very unusual. I think when the markets puked and the bond market started to blow up, he hit reverse. To me, it's pretty plain and simple. And I'm conflicted over the whole thing because on one end, I, I agree. There are some imbalances and there is a level of unfairness just at the surface when you're talking about tariffs and free trade, so-called free trade. On the other hand, the idea that the world should pay tariffs for the privilege of good, right? So much of this is not to support our manufacturing industry. It's bigger than that. And look, on the other hand, which is the part that not enough people are talking about, is that those same countries, they're keeping our system afloat by buying our treasuries, and they're using the dollar as the world reserve currency. This keeps rates low. This keeps asset prices high. This keeps goods cheap. So sure, the trade gap looks ugly on paper, Jesse, but is it really? Is the advantage that we get by being the reserve currency and having all of these countries recycle their reserves into treasuries, which maybe not doing so much anymore because of our behavior, is something to question. Is it fair to have both sides, right? So on one end, yeah, we have a trade imbalance, looks that way, but on the other end, these countries are supporting our standard of living and have for a long time. So look, tearing it all down without understanding the plumbing and how this will all unfold is not, to me, the art of the deal. It's more along the lines of maybe economic Russian roulette.
Interesting. And what do you think the after effects are going to be when it comes to the broad market? Because as you've mentioned, we saw the stock market and the bond market take a beating. Many are speculating that we're now entering into real bear market territory. I mean, it's anybody's guess. Today, last time I checked, markets were just about at zero to, a few basis points when it comes to the broad indices. And obviously, we already saw quite a big fall. How do you think the broad market is going to respond to this continued uncertainty, particularly if we see a ramp up with China versus the US in a full-on trade war?
Yeah, what we saw in just a period of 3 days was unparalleled. We saw the yield on the 10-year Treasury shoot up 60 basis points at the same time the stock market or the S&P 500 dropped by 8 or 9%. I'm not exactly sure the number, but I do know that it was the biggest jump in bond yields over 3 days since I think 1982. But one of the sharpest, if not the sharpest, splits ever between bonds and stocks. If stocks are falling, that means people should be running to safety into the arms of the Uncle Sam and to the Treasury, which should push yields down, but instead yields went up. And I guess I would say, honestly, this could become very bad for the bond market. And it's less about um, what had happened with other countries dumping treasuries. The rumor is Japan did dump a bunch, but it's more about this thing called the basis trade, which is a trade that hedge funds try to profit on tiny differences between the futures price and the actual bond price. And it's a very small amount that they make per trade or per bond. But the leverage that they're doing as much as 50 or 100 times is insanity. And so what you're seeing when volatility spikes like we saw, those trades can break down very fast, and these funds were forced to unwind or dump their treasuries onto the market, which drove rates higher and at the same time killed liquidity. But that's just one part of it too. You and I have talked a lot about the bigger issue, and that is countries that have been around the world have been offshore or off-putting or dumping their treasuries. Net, since 2014, there's been no new central bank purchases of our treasuries. Sure, they bought some, but there's been more selling by the central banks than by buying. So when you add that to the equation, on top of these funds that are massively, massively over-leveraged in a game that they thought could never possibly lose, well, you see what can happen. And it presents this deal where, look, if hedge funds are being forced to sell and central banks are being forced to sell, you're talking about yields spiking way faster than anyone could expect. And then that puts serious pressure on the Fed. Let's not forget, if rates are surging and inflation's still hanging around or deficits are exploding, all of these things seem to be happening all at once. Well, their options become pretty darn well limited real fast. And that's where we are right now. Do we lower? Do we hold tight? We were talking about raising forever. Now we're talking about lowering again. Where are we in a system where inflation is still roaring? Inflation is not going away. This is a breaking of the world's safest market, and that's when everything else begins to shake. So this could become very dangerous very quickly. We're not there yet, and I'm not signaling the alarm bells, but you see just how fragile it is, where just a less than 60 basis point move can break some of the biggest hedge funds in the world. Yeah, it's a precarious position.
Hey guys, just a quick break to hear from our sponsor, ARC, silver, gold, osmium for all your precious metals needs. ARC SGO is the place to go. Owner Ian Everard is trusted and given praise even by his competitors for being one of the most honest and informative gold, silver brokers in the United States. And their special is Silver Kangaroos 2023 1-ounce coins, mint fresh for $2.47 over spot, while supplies last. Take advantage of the offer by giving him a call at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Ray Dalio also coming out recently on mainstream financial press and warning that we could be on the precipice of some type of monetary reset, some type of potentially very, at least in the short term, detrimental action and a potential depression. He said what he's not worried about so much is a recession. That's just technically 2 quarters of negative GDP growth. But he's worried about farther reaching effects from this recent kind of shakeup when it comes to the international order. And he's been a proponent for holding gold for quite some time now. He was actually laughed at one point when he was at one conference saying that people should own gold, which is pretty funny given its long history as money and all the things that we know about it. Do you think, and perhaps, gold held up very well in that when the rest of the market was collapsing, gold only went down a couple percent, came back strong. It was one of the few assets that was holding its own while everything else around it was falling apart. Do you think we're going to start to see more flows, that safe haven flow of money from people who are looking at all the points you brought up and saying, maybe we don't want treasuries, maybe the US dollar isn't everything it's cracked up to be, maybe we want to own, our own money free of counterparty risk, as all the central banks have been doing? Do you think this could actually accelerate that momentum for gold?
I'm shocked it hasn't already. I mean, a lot of that is lack of media coverage, certainly, and a bias towards equities and treasuries. Yeah, I mean, it certainly ought to. The lack of alternatives is startling, and I again, it's almost as startling as the lack of any real information on the mainstream about alternatives to the mainstream or to the mainstream ideology of the road to retirement being paved with stock certificates and mutual funds. So, yes, I do. In fact, I think we'll see that in a manner that will surprise a lot of people. We're seeing it at the highest level, of course, with deliveries onto Comex and central bank purchases and family office purchases. The largest deliveries onto the Comex, JP Morgan delivering $4 billion in gold for a customer in February. So big money has noticed it. Retail hasn't yet. So ultimately, yes, I do think retail will be late to the party. But that's why investing, that's why there's a whole school of investing ideology, Jesse, like wave theory, Elliott wave, Kondratiev wave, based on human emotions. And so when you talk about are we anywhere near the top in gold, I mean, crap, the retail investing public has zero exposure to this, or as Rick Rule would say, 0.5% is what he believes for the entire financial matrix. And I think he says from Joe and Jane Sixpack to the Harvard Endowment Fund. So yeah, we have a long way to go. And that acceleration comes when the retail public wakes up.
And when it comes to financial advisors and institutions, they can't recommend physical gold for their clients because they don't make any fees off of the client going to their local coin shop and buying some gold or some silver. But what they can benefit from is gold stocks, and they've been undervalued relative to the metal for quite some time now. We are starting to see the gold miners catch a bit of a bid, but despite this, there still is that valuation gap. And now one interesting kind of thing to throw into the mix is the drop in the oil price, dropping to around $60 WTI crude, potentially lowering the all-in sustaining cost for these miners. Many of them are printing cash here with gold, at all-time highs as well. Do you think the market is going to catch on to this sooner rather than later? Maybe we'll see some of that rotation from these overvalued tech stocks into the gold mining space?
It's really wild, man. I mean, miners are finally getting a little love. I mean, it's crazy how they've done nothing and gold has roared. They're still trading like gold is $1,700, not anywhere near its all-time highs where it should be. And that disconnect for many has been very frustrating. What's the old adage that the market can stay irrational and we can all stay solvent? And you're right, a lot profitable now, especially with oil pulling back. Their all-in sustaining cost has come way down. Margins are widening. Some of them are printing cash. But it's like the market's still stuck, kind of like the retail side. The market's still stuck in this old narrative where miners are high risk, high cost operations. That's not the case anymore. But, I think in the end, capital always chases returns. And once you see the broader investor, the retail public, realize that these companies are throwing off cash flow, yeah, the sky's the limit. This is, again, when you talk about asymmetrical risk reward, low downside, high upside, the miners are people would be crazy not to own some. And I've always looked at the miners, Jesse, in my portfolio in the form of a pyramid, where the base of your pyramid, 60-70% would be cash, would be gold, paid for real estate. The middle portion of your pyramid, maybe 20-30%, would be, let's say, 6-month or less duration treasuries throwing off 4 or 5%, utility stocks throwing off a dividend, something like that, a little riskier, a little more return. And the top 10% would be the cryptocurrencies, the mining shares, et cetera. The theory is you lose everything on the top 10. You make nothing on the middle 20 or 30. As long as the base of your pyramid is not moving backwards, you don't move backwards, just making your slow, steady growth. But in a perfect world, yeah, you can make more money on that top 10% than the bottom 90 underneath you. So while we don't want to invert our pyramid to speculation, there is tremendous upside, certainly in the mining shares, which have not kept up with gold's run. I think they will, though. That I do believe.
Yes, and anecdotal evidence here, but gold mining shares are the only things. Well, I have to throw Bitcoin in there. That's a whole other conversation for another day. But those three asset categories are the only thing keeping my portfolio in the green, as the rest of it. My oil and uranium equities take an absolute beating. So make of that what you may. But I also agree there's so much more upside potential when it comes to the gold mining sector up ahead. I want to dive into a tweet you made recently. You said BRICS is building its own precious metals exchange to challenge Western pricing power, while the US threatens 100% tariffs in response. Could this be the start of a new gold standard without the dollar? Break down what you're currently seeing when it comes to the BRICS and the potential for them to de-dollarize.
Yeah, I mean, if enough countries start settling trade in their local currencies, especially if they're backed by or anchored to gold, even loosely, yeah, you're looking at a major challenge to the fiat system. And again, much like most people who have talked about this have said, it won't happen overnight, but it is. You are watching the foundation shift. These are the countries that have been buying all of the gold, and these are the countries that produce all of the gold. These are the countries that have developed the technology, whether it be the bridge technology or others that have come into being recently. They're the ones who not only understand what gold really is, accumulate it all, produce it all, but now have trading mechanisms in place to trade cross border with free from the swift interference. And um, like I think what this really is the BRICS understand. Yes, they want to break free from Western financial dominance. They want to break free from the dollar. They also want to break free from the price setting mechanisms. The fact that COMEX and the LBMA, which really are rather, let's just call them fugazi, right? What they are very fractionalized. They are very rehypothecated. And if everyone stood for delivery, overnight the markets would blow up. There is far more paper on the Western exchanges than there are bars behind it. As we were mentioning earlier, the LBMA, which is a T+1 settlement, in 3 days you should have your metal, or it should be on its way to you, is now T+8 weeks. Well, they're saying it's a lack of manpower and trucks, or is it? You got guys like David Jansen saying that they trade 2.9 billion ounces of silver per day, 3.5 times the annual global mine supply. And behind those 2.9 billion ounces are only 65 million ounces of physical silver. There's a problem there if everyone stands for delivery. And the same thing is true with gold. Somewhere in the neighborhood of 36 million ounces, I think, is the number of gold that is standing behind 280 or 90 million ounces in spot contracts. Really? So if every one of those contracts stand for delivery, what happens? And maybe that's why they pumped the brakes. And the BRICS, as I've been saying on your show and others for 4 years, have been exploiting this by slowly. This is the little by little part. This is why I love the logarithmic decay, little by little, then all at once, because what we have been seeing for 4 years is the little by little by little by little draining of the exchanges, starting with the LBMA and moving all around the globe. You even see the draining of the Shanghai Metals Exchange, but that's for a different reason. That's because the Chinese are telling their people through the Shanghai Metals Exchange to save in gold and silver, and they are state-sponsored savings programs. So there are lots of deliveries, but on a bigger level, to see the LBMA be massively drained of its gold and silver, and the COMEX, to see a change in the T+1 to T+8 weeks as a result of all of this demand, standing against a fractional fugazi system. And by the way, that's the same environment that the Hunt brothers realized in 1980. Way more contracts than there are bars. Let's buy up all the contracts and stand for delivery. Really, that became a problem, and the COMEX did what it could to save its own by changing the rules. But the LBMA is not an exchange like the COMEX is. There's no central clearing authority. There's no exchange to make rules. It is an over-the-counter, peer-to-peer trading network, much less regulated, much more opaque. And you're talking some of the biggest banks in the world are really in a very, very dangerous, I say, existential threat position by being wickedly short, without the ability to get those bars for delivery if requested. And what's really different now more than ever before is the standing for delivery. And when I started talking about this in 2020, I would say, look, less than 1% of all these COMEX contracts ever stood for delivery. Same thing is true on LBMA, not a lot. And now all of a sudden, this is the Achilles heel. This is what the BRICS countries understood. This is what the Trump administration understands. This is why we've seen north of 50 million ounces of gold delivered since November. This is why the U.S. has become a net importer of gold since November. This is why we're seeing the largest deliveries of gold and silver into the COMEX ever, because they understand this. And they called it Trump tariffs. No, it's not Trump tariffs. It's that this administration, Scott Bessent, when he was before he became Secretary of Treasury, he was running a hedge fund. His largest position was gold. Judy Shelton wants to issue 50-year treasuries pegged to gold. She told me Trump plans on doing this July 4th next year, the 250th anniversary of the country. She said he's going to do it. We've talked about it. Well, we'll see. But if you're going to peg gold to a new system, to a treasury market that has lost demand, that is weaponized, that is seeing since no new net buying by central banks since 2014, it's because of the lack of trust. It's because of the mismanagement of the system. So, yeah, I think it's a real deal. It's a very big deal. And because of the way the BIS, which is a Western institution, pulled out of Enbridge at the 12th hour, embarrassing, humiliating the BRICS countries, I don't think they're going to be open or forthright or candid or transparent about anything moving forward. I really don't. They're just going to get their ducks in a row. They're going to continue to do this stuff. They're going to be much more closer to the vest. And these are the kind of things that are happening in real time. I think it's a big deal, and people should not lose sight of the significance of this happening. And even a quasi gold-backed trade system would be enough to start to really derail the settlement status of the U.S. dollar, which ultimately impacts its reserve status. It's a big deal.
So silver nearing $35 pre-Liberation Day, having a lot of people very excited, and then it got smashed along with everything else. Unlike gold, it did not hold up in the same way. It took a dive below $30, now staging a recovery. But I'm wondering what your thoughts are on why silver did not hold up in the same way that gold did. Is it because it's no longer seen as as a safe haven asset? Is it simply because, as many people point out, central banks aren't buying it? It's much more speculative. Why do you think that is, and what are your thoughts on the future of silver here in 2025?
I think it's the most undervalued asset on the planet. I think asymmetrically, there's nothing like it. Low downside, high upside. But what's really interesting is while the price took a hit, we're seeing huge deliveries, which we've been talking about for a while, coming from the LBMA into COMEX. And this is not retail flow. It's serious money positioning behind the scenes. Look, silver's still in a structural deficit. And when you talk about solar, electric vehicles, green tech still roaring, let's not forget the military industrial complex and its need for silver. To me, it's a coiled spring. And if it breaks through 30 again and holds, which obviously, where are we today? We're well above 30. So let's see, what are we at here today? Let me look and see. So I know it's a down day today. We have silver at where the gold price, silver price, 32.20. So breaks through 32 and holds, which it has. Look, upside is the upside potential on silver, Jesse, is it's off the charts as far as I'm concerned. And when you see the LBMA at this point having 260 million ounces of silver standing behind what amounts to 2.9 billion ounces in daily trading, 3.5 times annual global mine supply. When you see a situation where the LBMA has gone from T+1 to T+8 weeks, they're being drained. When you see the amount of deliveries coming into COMEX, off the chart deliveries, again, this is not retail. I think silver to me is strategic. It's not industrial, and I think it's an existential threat to some of these big banks who have been doing all they could, let's just say behind the scenes, to position themselves maybe to slowly pull away from these massive leverage short positions. at least the smart ones are, and maybe that's what a lot of these deliveries onto COMEX represent, is the bringing a reshoring of gold to back these leveraged and naked short positions, which very quickly can turn this whole thing upside down. So look, you get through 35 is really what I mean. Then you're off to the races. It's, you can look at 30, you can look at 32. These are certainly numbers that are big round numbers that silver's had a hard time getting through for a long time. But the real number would be to get through 35, and from there it's off to the races. To me, silver is, from a standpoint of risk versus return, I don't know that there's a better place on the planet, honestly. And when you see the amount of deliveries, that signals to me big institutional smart money knows that and is doing all they can with the price in order to reposition into much sounder footing moving ahead.
Yeah, I was actually speaking to David Morgan and Peter Kraut recently on the silver space. They were talking about growing silver deficits, the ever rising demand coming from the industrial sector, but they also pointed out that they think investment demand from the retail public will eventually pick up considerably as we see gold keep climbing and people look for a cheaper alternative. People who are looking to perhaps safeguard their wealth are then going to look to silver instead of gold at whatever, $4,000, $3,500 an ounce. What are your thoughts there?
I'm surprised it hasn't happened sooner. And they're both right. Both good buddies of mine, and both very, very smart people. And it's true. The retail side of things has been completely and totally left barren by the mainstream. And with gold roaring at all-time highs and silver still only 60% of its all-time high, with the fundamentals that it truly enjoys, yeah, it to me is something that I'm rather surprised has been ignored by well-read, sophisticated traders. That won't last forever. The retail market has, other than the hard asset community, wouldn't know a silver eagle if it fell on their foot collectively. So yeah, I think to not have some exposure to silver right now is a generational mistake. I'm sincere about that. Hope people can sense that.
Yeah, I think they definitely can, and I definitely agree with you there as well. You know, we've talked a lot in the past about polarization, left versus right in the US, leading up to the presidential election. It was quite an extreme. Some might argue that it's gotten even more extreme now. We've seen the attacks on Tesla, both the dealerships, the factories, as well as even individual Tesla owners, in quite a spat of violence coming from the left. You could even call it terrorism in some cases. It seems like things are ramping up here. What are your thoughts on this political polarization? It's kind of like my team versus your team, and whatever my team does is fair game. It doesn't matter. I don't care. Whatever your team does is wrong. Do you see that accelerating as well? And how does this all end?
I mean, that's kind of like cancel culture. It's the same crap that we saw for the last 4 years. It's the left, which really isn't the left that I grew up under. It's not the sex, drugs, and rock and roll left. It's a group of people that are so entrenched in their beliefs that even owning a certain brand of car is enough to make you a target. My daughter drives a Tesla, man, and it freaks me out. It truly does. It's not about Tesla. It's about symbolism. And it's activism gone too far. And I think that it's, again, we're a very divided country. And I contribute most of that to the last few administrations, or the last administration especially, but more so the media, who has done a great job of dividing this country. And what used to be Twitter fights or YouTube fights in the comment now turns into real world attacks. It's unhinged, it's dangerous, and it's embarrassing to this country. So look, hopefully we get cooler heads to prevail, and this tribalism doesn't turn really physical. It's hard to put that genie back in the bottle if it does. So look, if you've been following me for a while, you know that I have really spoken out a lot against that. That to me has been more disheartening than the ills of the of our monetary policy or our fiscal irresponsibility. It's more what's happened to this country, and the divisiveness that we have between red and blue and black and white and vaccine and no vaccine and rich and poor. I mean, all of these things have become polarized, and instead of just being Americans, we all have to, I think, or we have had to kind of choose sides, and with those choosing of sides, um, it's become very scary, and this is as scary as it gets when you're getting cars that are being Molotov cocktailed and dealerships and all of these things. Yeah, it's something that I find pretty appalling.
I want to get your thoughts on this defense budget announcement because Trump revealed that the U.S. defense budget in 2026 will be $1 trillion, the largest military budget ever, at least according to him. I haven't actually checked on that. I thought the ideal was to cut spending, right? And to get the debt and deficits under control. This seems to be adding fuel to the fire. So is this really necessary in your view? And how can the U.S. ever get its financial house in order with this kind of spending?
Well, it certainly adds fuel to the inflation fire. Pressures the bond market at a time when the bond market doesn't need any more pressure. Um, I guess you could argue it sends a signal to the world that the U.S. has no intention, no matter what the rhetoric is, of fiscal restraint. Um, Look, I think military spending is important, no question about it. But when you're spending 10 times what the next, um, or more than the next 10 countries combined, rather, um, you have to ask yourself, where's the oversight? A trillion seconds ago was 31,680 years ago. We're not just risking doing this. We're risking global trust in the whole dollar system itself because our debts are increasing at too fast a rate, and they're unsustainable. Look, by not to sidestep the question because that kind of answers it, but when you add on to it that by 2028, in 3 years, we have $28 trillion in treasuries that come due. Now, Trump's talking about Doge, which is, going to lessen the amount of tax revenue that the government takes in by cutting all of these jobs and waste and whatnot, spending. But at the same time, he was talking about a big tax break. Well, we take in roughly $5 trillion a year in taxes. So forget about the tax break, which he's talking about. Let's just say it's $5 trillion. That's $15 trillion in tax revenue by 2028. We owe $28 trillion in bonds that are coming due by then. That doesn't take into account the amount of spending that we have over the next 3 years. We're broke. And so when you are spending $1 trillion per year just in military, which doesn't take into account all of the things, and that's discretionary, mind you. That's not even mandatory spending. So in other words, we have to borrow money to fund our defense system because by 2030 or 2031, the Congressional Budget Office says 100% of all tax revenue, all of it, will go just to pay the interest on the debt and those mandatory entitlements that aren't even on the balance sheet, like Medicare and Medicaid and Social Security. So at some point, this is why I say you're risking global trust in the dollar system. We're broke, and we have commitments that we're borrowing money just to pay the interest on the debt, and borrowing money to fund our military, which we use to go around the world, coercing and using sanctions and standing behind. You can't make it up. It's like some silly movie. So yeah, I think it's a big deal. Everyone wants to have a strong military, but there comes a point where can it be your undoing? And let's hope not. But it doesn't make a lot of sense, at least in terms of balance sheet wise.
Yeah, some great thoughts there. Tell us about Miles Franklin Precious Metals and where people can find it.
We've been in business for 35 years, Jesse. We've done all of it without a material customer complaint. Over 12 billion in sales. We're easy to find. MilesFranklin.com, of course. For people who want our most competitive price list, a price list that will be as good or better than anyone in North America, send us an email at info@milesfranklin. We only publish a very small amount of prices online. Info@milesfranklin will send you our competitive price list. You won't be sorry that you did. There's no obligation. No one will even follow up with you unless you ask to be followed up with. And if so, put your phone number down, and any questions that you've heard on this interview or any other that I do or anything metals related, we would love to chat with your listeners. Again, that's info@milesfranklin.com. No obligation. And that's probably the best way to get in touch with us. Certainly, we have our own YouTube channel, the Miles Franklin channel, which you were on and got great comments, and I appreciated that. But I'm pretty easy to find these days.
Right. Yeah. I'll put a link to milesfranklin.com. I'll put the info@milesfranklin.com email, as well as a link to the Miles Franklin YouTube channel. You do a fantastic there show called Little by Little. It's really picking up steam, and you're fantastic in the interviewer role as well. So I recommend people do subscribe. Do that in the description below. Thank you once again, Andy. It's always an honor having you on the show.
Yeah, brother. I'm sorry we're having some internet issues today, and I had to move locales right in the middle of the interview. But you pivoted as usual marvelously, and you're one of the good guys, Jesse. I'm sure the people who follow you understand that, and it oozes from you authenticity. And I appreciate not only coming on your show but calling you a friend in the industry. So thanks for having me on. Sincerely, I look forward to picking up where we left off again, hopefully real soon. And I hope you and yours stay well.
And thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium, for all your precious metals needs, and to take advantage of their special right now, which are Silver Kangaroos 2023 1-ounce coins, mint fresh at only $2.47 over spot. Be sure to reach out to owner of ARC SGO, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.